Hey, what's up, guys? This is Sam, and I'll be doing the free video for Friday, November 11th, 2022. So, a very good week for the Bulls is in the books here. Mostly the last 2 days, really, but it was a heck of a last 2 days. Yesterday was the third biggest short squeeze on record, I think, that I've seen. Quite impressive. You will not see very many days where the QQQ goes up 7%. So those are always fun. Let's spend some time here kind of building on what we talked about last week in this free video. So last week in the free video, I showed you guys kind of what I thought to be the path forward on SPX, and we're kind of making our way there. Right? It's certainly the cold CPI from Wednesday or Thursday, I should say, certainly helped. So the question is, well, what's next? What can this thing do from here? And let me just start by just kind of giving you kind of a little bit of the lay of the land before we cover the charts. So the cold CPI, what it does serve to do, at least in the very near term, is kind of shift the narrative away from the inflation story and higher and higher interest rates. And at least in the near term, what it does is allows a little bit of potential wiggle room, or at least that's the narrative, the potential wiggle room that the Fed might be able to slow down, or at least signal that they're ready to slow down coming up, right? Because they've been looking for a colder inflation print, and really the inflation is looking like this, right? It's up, 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 and it's not really fallen, but it kind of has a little bit of a dip here. So that being the first dip, what folks are thinking is, hey, well, that means that it's going to start doing this, and as it starts doing that, then the Fed doesn't have to raise rates as much, and then that means that all risk assets can go back up. So at least that's kind of what the stage is set for. In this video, what I'm going to do is actually just kind of round back to last week. We're going to cover the SPX here as a primary just driver for everything, and then I'm going to show you what I think are the two most important markets. So it's going to be the dollar and it's going to be bonds. And I actually think bonds are more important than the dollar. So let's dive in here on the SPX. On SPX here, I still think you have to drive you have to steer the ship here. Do you steer ships? Let's just go with it. You have to steer the ship with the hourly. And the reason being is if you look at the weekly chart, the weekly 50 is still sloping down, and you still have a series of lower highs and lower lows. So it's still a downtrend. The daily, you have a hard sloping down 200, and you also have a series of lower highs and lower lows. So the daily is still a downtrend. The hourly, however, has shifted. Do you see how the 200 went from, it gave you the hook? Now last week, remember what I told you, the 200 period hourly needed to hold. Otherwise, there's nothing underneath the thing, and if they had broken it, you would have basically, had a free fall. But look what happened. The 200 was falling. It stabilizes. It turns, and each test of the 200 holds, and now you've made a new swing high above the previous highs. So, in terms of the action, that's as good as it could possibly be for the bulls. So you still do have a downtrend here. You do have a downtrend on the daily, but now on the SPX hourly, you could argue an uptrend. I'll just say uptrend to make it simple. You could argue kind of sideways to up, which I think is probably a little bit more accurate, but let's just say uptrend. So if that's the case, and you're trying to look at the market bullishly, well, the daily chart isn't really the ticket. The weekly chart certainly isn't the ticket, but the hourly chart is starting to show it. So with the hourly chart being kind of the way that we're going to drive this, we're going to steer this ship, where do you think the next place to buy the SPX, or frankly, whatever you're in, would be? I would say it's probably going to be the hourly 21, right? Because you see how the hourly 21 crossed through the 50, and it has not been tested since the CPI number came out. So at some point, price will reconnect with the hourly 21, and I do think that offers it's still aggressive, but it's not that aggressive buy entry. Now, mind you, right now as we speak, the SPX is 72 points away from its hourly 21, so I don't have a ton of interest in buying it up here until it gets that pullback, and either one of two things will happen. Either price comes down into the moving average, which is fine, or price does nothing, and the moving average comes up to it. and then at some point they reconnect higher up. Whatever the outcome is, the buy zone in my book is the hourly 21. If you want to be a lot more conservative, especially if you're going to be setting something up that's a little bit longer term, then I would look for the hourly 50. Now, I don't expect the hourly 50 to be tested immediately because the hourly 21 hasn't even been tested. So just be aware. Slightly aggressive entry here, much more conservative entry here. The risk is you might not get this for some time, whereas I do expect you will get this one relatively soon, next week. So I'll leave the levels up here for a second for you. 38.15, 39.15, 4,007, 40.81, and then the big one that I've been calling out, 41.80, is 100% still in play. So that's the SPX. And of course, if you understand what I just said about SPX, you can use that to basically trade anything, right? Like the same idea would apply to the NASDAQ or the Dow or Apple or Amazon, right? Whenever the SPX reconnects with its hourly 21, that sets up the buy in most whatever you're looking at. Let me show you two things here real quick. So first is going to be the dollar, and we'll just kind of blast through these because hopefully they'll be pretty self-explanatory. The main thing here is we've had some pretty big rallies, right? Remember the rally from July into August? That was a big rally, right? I think it was, 20% or so? But this is the first time that we've rallied, and the peripheral parts of the market, like the dollar, and more importantly bonds or interest rates, have actually cooperated. So this is a different type of rally, even though it's not as strong yet as the June-August or July-August rally. It's of a higher quality based on the peripheral markets of the dollar and interest rates. So here on the dollar, this looks to be a proper breakdown here, right? You have the series of lower highs here at the top, you had a flat bottom, and you cracked it. You cracked your weekly 21 over here, it's the green line, and if I trace it in, you'll see it hasn't done that before. So this is very, very welcome for the dollar, or for bullish behavior in general, and the dollar here will mostly benefit things like metals, multinationals, to some level oil. Commodities should get a bonus, but I think actually the better play is going to be things like technology, and I'll show you why here in just a second. But the dollar generally benefits. It gives general tailwinds to most bullish assets. So this is a big change from what we've seen. The second big change, and I think this is the more important big change, although it works well with the lower dollar, is actually the interest rates. So this is the 10-year interest rate, this is the TNX, and again, you're starting to see some things that you haven't seen before. One is it finally cracked the daily 21, right? Two, you made a high across a major extension. You made a lower high, and then you went on to make a lower low into the 50. So let's say the dollar bounces here off the 50, which it probably should. The setup here is now that the dollar will bounce, make a lower high, or excuse me, this is interest rates. Interest rates will bounce, make a lower high, probably fail at 40.23 or slightly lower, and then make a lower low, right? And if this does occur, and this pattern continues of kind of lower highs, lower lows, what benefits from this? Technology, software, semiconductors, home builders, utilities. What doesn't really benefit from this? It's all the stuff that's been working. Energy, healthcare, potentially staples. But let me also add what benefits from this: technology, semis, software, utilities, home builders, but also consumer discretionary. So things like Amazon or even more retail stores, things like that. So I think this is a rally of a higher quality than we have seen. And it actually, looking across the different markets, it has the right look for an actual bottom. Now, here's the thing. I don't actually believe that. But it looks correct. And the best thing that can happen if you're bearish, like I am longer term, is folks believe this is the bottom. And then we go into December, something changes, Powell says, what are you guys doing? This isn't what I want. You've undone all this progress, because keep in mind, as people bid up stocks, it brings back the inflation story. So I think something happens further down the line, that will correct all of this. But the best thing that could happen for bears here is actually a giant and believable bounce in the market that convinces everybody the bottom is in, and then boom, they get whacked again later on. At least for now, that's a story for a later video. The story that's in front of us is there's enough signals here from the peripheral markets to the indexes, and there's enough alignment that they could take it into the December Fed meeting, and then from there we'd have to reevaluate. But that does buy us about a month of a potential short squeeze slash rally slash melt up, whatever you want to call it. All right, guys, that's my time. Hopefully this is helpful. If you have any questions, go ahead and drop them below. If you have any comments, concerns, complaints, or grievances, drop them down there as well. Leave us a like before you go somewhere else on the YouTube. Also, leave us a subscribe if you're not already subscribed, just because, well, we try to bring you guys good content, and it's completely free. So leave us a subscribe, leave us a like, leave us a comment. All of those free things help us with the algorithm, help us reach more people, and we certainly do appreciate it. Have a great weekend, guys. See you for the next video. Cheers. Hey traders, this is Sam with Simpler Trading. I want to thank you for watching today's video. Hopefully you found the information in it helpful. If you did, leave us a like, leave us a comment. It really does help us out with the algorithm. And if you want to see us trade live with our own real money and be part of the community, come and check us out at simplertrading.com.